when countries reach 130% debt to GDP on the public level, there's a 98% chance that they're going to default in some way over the next 15 years. And that one exception was Japan. The US is at 120% debt to GDP or so. And the problem is we're not Japan. Even Japan's not Japan anymore. And so when you get to that level, there's going to be some sort of default. And the question is how? A couple milestones to watch is one.
Let me break this down for my fellow Bitcoiners. In just 8 weeks, I've seen a serious shift. More strength, more energy, and fast muscle gains. The reason? FITSCRIPT. They ran 124 biomarkers, blood, hormones, inflammation, and built a fully custom plan, nutrition, training, supplements. No guesswork, no templates. This is functional medicine meets precision fitness for high-performing men who want sovereignty over their health. If you care about optimization the way you care about your money, test, don't guess. Don't trust, verify. Hit the link in the description or scan the QR code on the screen to check out FITSCRIPT and see what's possible. You opted out of the broken financial system by adopting Bitcoin and taking self-custody of your money. But protecting your wealth is only part of the equation. Now it's time to protect your freedom. My family is stacking sats and stacking flags. A second passport is our hedge against government overreach and uncertainty. If you're a Bitcoiner looking for your exit strategy, our friends at Citizen X will help you secure second citizenship through investment or descent. Book your free call today by hitting the link in the show notes or simply scanning the QR code on the screen. Now, in terms of U.S. debt, I believe we recently passed 37 trillion. Is that correct? I think
Something like that. Yeah.
Yeah. And I wanted to maybe talk a little bit about something. Historically, there's been a level, and maybe you'll enlighten me on what the ratio is, but the debt to GDP ratio or threshold, where historically speaking, it's typically been an indication that there's going to be a default in a lot of various nations, either nominally or just through printing, like a soft default. Now, up until very recently, the example that was kind of held up as, oh no, see, this works fine, is Japan. But Japan has had some interesting troubles this year. And I'm wondering if, one, you could maybe bring to light, you know, what is happening with Japan? Why were they able to kind of duck and weave their way around that threshold of debt to GDP that seems to be the kiss of death everywhere else? And secondly, how, you know, the US debt to GDP is getting up there quite a bit. And how does the dynamic of them being the world reserve currency play out in relation to this? Do they get a free pass? Is it just a little bit more of a kick of the can down the road? What's the end game here? So I know there's a lot there, but I'll let you go ahead.
Yeah, lot there, but great questions. I'll start with the first half. So to quantify that, and this is kind of, I think, indirectly the study you're referring to, and this made its rounds years ago, and I also cited this a number of times, which is there's a study that showed that when countries reach 130% debt to GDP on the public level, there's a 98% chance that they're going to default in some way over the next 15 years. And it was a sample size of something like 52 entities, sovereign entities that reached that level. And it was over a very long period of history. And that one exception, so the 1 out of 52 that didn't have what could be considered a default over the next 15 years was Japan. That they managed to kick the can down the highway even at that level longer than anyone else. And what they define as a default is not always a nominal default, but it's either if it's an emerging market where the debt's not in their own currency, it's likely to be a nominal default. But other times it's a major debasement where bondholders get a significantly reduced purchasing power from their bonds, even though they probably got paid back every unit that they were owed, on paper.
Yeah.
And so when you get to that level, there's going to be some sort of default. And the question is how, or are you the 2% exception? In Japan's case, and I actually wrote about this. I don't know if it was 2022 or something. It was years ago, explaining why Japan, following that one exception, is not the one to point to. So a lot of times in the U.S., when people talk about the debt, the deficits, they'll say, "Well, look at Japan. And, we're fine for now." And the problem is we're not Japan. And then my argument also in that article is that even Japan's not Japan anymore.
Yeah.
To your point, and since then they've had some major issues. So my point is Japan's no longer Japan, and U.S. never was Japan. So the reason that Japan had a number of ways to go longer, one was although they had the debt, they also had assets. So if someone is 200,000 in debt and has no assets, they're in trouble. If they have 200,000 in debt but they have a 300,000 home attached to that debt, that's a very different financial situation.
Right.
That's an extreme example, but Japan was more in that situation, which was they have a ton of sovereign debt, but they also had years, like decades of current account surpluses, trade surpluses. I mean, they were the absolute powerhouse in the 60s, 70s, and 80s. Um, the people at the time. That's why all the cyberpunk like literature that came out in the 80s was always like centered around like Asia and stuff because that was
Yeah.
and like in Die Hard.
Yeah.
They were in a tower owned by a Japanese company because that was they were just dominating for a brief period.
Yakatomi Plaza.
Yeah, a brief period of time, Japan had a bigger stock market cap than America, with a fraction of the population, and it's because I mean, part it was overvalued, but also they were just dominating, um, and they basically saved it. It's like they ran a really big surplus, and they're kind of retired now, but they're that retired person that has debts, but also a ton of money. It's kind of what they did. So they have one of the largest net international investment positions, meaning they owned things throughout the world. They own stocks, they own bonds, they own shares of companies or mineral deposits around the world that pay them dividends and interest and commodities when they things like that. While they also have a lot of debt, and then the second thing is that they even to this day, despite their demographics issues, are extremely productive. And they've got a unusually high level of societal harmony, which is it's a type of human capital. If you've got a very free and organized place, you have to spend less money on security, less money putting out fires, less money just surveilling everyone to try to make sure no one's going to blow something up. It's like you spend less on the problem areas because everyone's already kind of working together and there's less extreme things happening. Two, I mean, the median age of Japan is like 10 years older than the US, but they spend something like a third of on healthcare that we do, and they live longer.
Yeah.
And it's partially diet, it's multiple other factors. The US, the meme is kind of like we pay 3 times per the same pill that everyone else in the world pays for the same pill.
Yeah.
We've got a weird hybrid system of healthcare that's a problem. But basically, and they also pay much lower percentage on defense. So even though they're running big deficits and stuff, it's actually mostly going to the people. Like it's like they're debasing themselves slowly, but it's not as though it's being siphoned off into corporations and black boxes. It's actually mostly flowing back into the people, so that there's more of a tolerance for it, you could say. Um, Now they still have other issues. Like the complete reduction in fertility, the social isolation that happens there. I'm certainly not an expert in those things. So they have paid a price, either correlated or caused with this whole endeavor. But mathematically, they've had much more resources to deal with their debt cycle than most other countries that reach that level. And so I've always been kind of a Japan bull ever since kind of the whole past decade. So they've had a famous lost decade in equities, but it's not been a straight line. They actually bottomed back in like 2012, and it's really been a strong equity market ever since. Um, and the current, I certainly don't want to be long the currency, but you can be long equities that ironically themselves are often short the currency. They have debt in Japanese yen, and I'm like, all right, I'll own assets at historically good prices that are have their liabilities in yen. All right. Um, and so, it has been an interesting thing. Now, most countries, and when they do get to that fiscally dominant stage, you're more likely to default. And even now, Japan has kind of reached, I would argue, the end of their multi-decade deleveraging cycle in the private sector, and they are entering more inflationary times. Another kind of key thing is that um, Japan aged, but the rest of the world, they were first to age essentially. The rest of the world, you had the rise of China and everything. So you had this kind of still like productive disinflationary period in global history that Japan could benefit from. So they could get cheap labor from China, and they can get cheap labor from elsewhere, and they get cheap soybeans from, XYZ. So even though Japan had certain limits, the world didn't. Now the problem is when China ages, when the US ages, when Europe ages, when all of these other things kind of are in Japan's situation, there's no newcomer China. Like China is now old, US is old. There, like it's not like India is still on their ascent, but that's not big enough. That it's like it's not big enough to fuel all this. Or like Nigeria is still in the there's not enough like emerging markets to fill that hole. So the world now is entering an older arc, and it's very different when everyone enters it versus when the one leading country enters it.
Right. Now, in that same vein, again, Japan was able to sidestep this stuff. The U.S. Is, if I'm not mistaken, I was trying to look at a stat. I think they're in the realm of 120% debt to GDP, somewhere in that ballpark. How much of a problem is that currently versus how much it may be in, say, the coming 5 to 10 years or so? And um, does the US's position give it a little bit of a mulligan here, or is it all bad? Do they maybe just kick the can down the road a little bit further? How does this all equate?
Yeah, good question. That was the second part of your prior question that I didn't get to because it was sorry about
Sorry.
that. So basically, yeah, the U.S. is at 120% debt to GDP or so, and we're kind of at the part where our deficits are flowing back into the economy nominally, and so all the numbers are kind of rising nominally. So we don't really have rising debt to GDP so much anymore. It's like both figures are going up, and debasement's taking the hit. Um, Over the past 5 years, so I wrote my kind of my bond bubble article back in 2019. And I've been reiterating ever since, which is to say that when you enter fiscal dominance, bonds get killed essentially. And these past 5 or 6 years have been like the worst period in treasuries in like modern history. Like you go on these like 2 century charts, and it's like this is like the worst or second worst. It's like awful. So in some ways, it's already mattered. We've already started that process of basically defaulting on people who in the late 2010s were happy to own currency and happy to own bonds and making arguments for inevitable disinflation due to demographics, or whatever their arguments were. We just said, okay, you have fun holding that stuff because, and we just killed it. All the money printing, all of the ongoing deficits. We just currency holders and bond holders just really took the hit. And if you own equities, if you own gold, if you own real estate, if you own Bitcoin, and especially if you had some degree of short on the currency tied to those things, like either a mortgage or MicroStrategy with their fiat currency shorts and Bitcoin longs, whatever the case may be, then you juiced up that was the trade to be in. Now, I still think we have longer to go for these things because the debt's not fully devalued yet. The problems are still happening, but that's kind of the down payment of the default, which is like that's the
Yeah.
opening volley of the default. So it's already mattered. The couple milestones to watch is one. So the U.S. Social Security Fund. Um, so how much debt we have actually depends on what you look at. So there's some of the debt is held by the government, ironically. It's intra-government debt. And that's a lot of that is tied to the Social Security Fund. So our like external debt is something like 100% of GDP or a little over, whereas our full debt is like 120% plus because some of that is owed to Social Security and things. Now that's in drawdown mode for the first time like ever, really. And so
What does that mean?
what that means is that for decades, more money was going into Social Security than coming out of it.
Mm.
And that's largely demographics. So baby boomers being a particularly large generation, as they worked, and especially as they entered their high income years, all that money's going into it. We don't have that many retirees. When baby boomers entered their retirement years, and there's no big generation behind them, they start pulling money out of it. And we never really like we had these entitlement systems in place that are not they were kind of designed as though every generation is going to be bigger than the prior generation. We kind of Ponzi their math a little bit, and so as we get a slowdown in fertility and immigration and other things like that, the next generations just aren't as big. And so you have more retirees per worker, which is a problem. And so now we're in drawdown mode. So we have something like $3 trillion stashed into the Social Security Trust Fund, and that's now drawing down. And the estimated depletion date is somewhere around 2034, 2035, depends on a few factors. Um, and when that runs out, unless there's kind of like legislation to something to kind of direct money printing toward it or something like that, because they're a separate pool of taxes than other things, um, then Social Security checks could be cut going from that point going forward. They could lose like a third of their value or a quarter of their value going forward because there's not enough incoming money to cover it. So it's already the case it's not enough incoming money to cover it, but because they have that $3 trillion trust fund, they can fill the difference by drawing that down. But when that's drawn down, certain decisions have to be made. Either you kind of keep printing and do all the legislation you need to make that happen, or we get politically gridlocked and there are some defaults basically in Social Security entitlements. So that's something to watch. The broader question of does the dollar's reserve status give us a free lunch on this? It both helps us and hurts us because it gives. So I've made the case multiple times that, and I'm not the only one to do it, that the dollar's reserve status gives us strength, but it also gives us weakness. So unlike Japan, to my prior point, they ran decades of trade surpluses. They built up this big war chest of assets because of it. The US, in order to support the reserve currency, we run structural trade deficits. Another way of putting it is that the whole world needs dollars because it's the global reserve currency. They use it for cross-border lending. They use it for currency trades. They use it as a reserve asset. They use it for international unit of account contracts. They all need dollars, trillions of them. And the question is, how do they get them? Well, the answer is they basically overvalue the dollar on a trade basis. So they boost America's import power. They hurt our export competitiveness for lower margin things, which generally means physical, manufactured stuff. So we run these structural trade deficits, and we spew dollars into the rest of the world year after year after year, and that's how they get dollars, which they need to use dollars as the global reserve currency. So those two things are kind of tied to at the hip, which now is politically a problem because when you run 4 decades of trade deficits, you hollow out your industrial base. If there's a pandemic, you can't make ventilators. You find out that a shockingly high percentage of your rare earths or circuits or other components of your military are built by your potential adversary that you are worried you want to have those military assets because you're worried about, which is a problem. And that's been known for a while, and it's kind of finally hitting its head. Um, and so the dollar status gives us a lot of kind of extra resilience for a while, but the other analogy that I've used in broken money is like a box that doesn't feel pain. It seems like an advantage, and for a while it is. Like if one boxer feels pain, the other one doesn't feel pain. And there's actually some people that have that condition.
Yeah.
uh, at first you're just dominating because you're untouchable. The problem is pain is a signal to adjust, and if you don't have that signal, you just ignore it. You could break your arm and just keep going, but eventually that damage accumulates even though you don't feel it, and you can't even get up. Whereas someone who could feel pain would fight more defensively, make adjustments, and protect themselves better. And so the United States, by having the global reserve currency and forcing us into our massive twin deficits of fiscal deficits and trade deficits, we are hollowing ourselves out. And it took us a long time to truly feel the pain. Some pockets, felt the pain, the Rust Belt, so Detroit and all of Ohio and parts of Pennsylvania and basically the whole area felt it. But they were not they were the minority compared to all the capital being put elsewhere. But now it's kind of hit the head where it's actually starting to be felt more broadly. And the problem is we're kind of the boxer that doesn't feel pain, but now has trouble even getting up because
Yeah.
we've taken so many hits while not really feeling it. And that's the problem. Another way of putting it is that a normal economy kind of stands on its own 2 feet. The U.S. is like this really imbalanced economy with really big strengths and weaknesses. So we're kind of like someone who's pushing really hard against the wall, and if that wall breaks, we just fall over because we're not balanced in and of ourselves. We're kind of reliant on this ongoing thing. So basically, the loss of like using reserve currency eventually kind of hurts your ability to still be the reserve currency because you no longer have the industrial base, the military strength, the rule of law, all these kind of things that for the reason why we're the reserve currency, we start eating those away, kind of like drawing from savings until we don't have several of them anymore. Or at least the metrics on those things have all decreased substantially. And it gets bad enough where we kind of lose that. And the problem is when we lose something that we're kind of built as though we always have, we can get hurt a lot more than a country like Japan usually will, because we're now in a position of weakness on more fronts than they were.
Hey, you. Yes, you watching the Bitcoin price movements and the latest exciting news. It's awesome to stay informed, but the real power of Bitcoin comes from taking control. Don't just watch, take action. Head over to btcsessions.ca/learn for free step-by-step tutorials that guide you through every major skill you need to know, plus full video playlists for deeper dives on any topic you like. And if you're ready for the ultimate fast track, scroll to the bottom and check out bitcoinmentor.io for premium one-on-one experience with my team of Bitcoin experts to ensure you get it right the first time. Don't wait. Secure your Bitcoin future today. Hit the link in the show notes or scan the QR code on the screen.